When trading cryptocurrencies, understanding order types is essential for executing trades effectively. The two most fundamental order types every trader should know are market orders and limit orders. Each serves a different purpose, and understanding when to use each one can significantly impact your trading success. In this video, we'll explore both order types, how they work, and when to use them in your crypto trading journey. A market order is the simplest type of order you can place. It's an instruction to buy or sell cryptocurrency immediately at the best available current price in the market. When you place a market order, you're telling the exchange that speed is your priority, not the exact price. The order executes instantly at whatever the current market price is. This means if there's enough liquidity available, your order is guaranteed to be filled. Market orders are perfect when you need to enter or exit a position quickly, and the current price is acceptable to you. Let's look at a practical example. Suppose Bitcoin is currently trading at $45,000. You decide you want to buy one Bitcoin right now using a market order. The moment you submit this market order, it will execute immediately at the best available price, which is approximately $45,000. You might get it at exactly that price, or it could be slightly higher or lower depending on market conditions at that exact moment. But the key point is that your order fills instantly, and you now own one Bitcoin. A limit order is different from a market order. With a limit order, you specify the exact price at which you want to buy or sell. It's an instruction to execute your trade only at your specified price or better. For a buy limit order, this means at your price or lower. For a sell limit order, it means at your price or higher. The advantage is complete price control. However, there's a trade-off. Your order will only execute if the market reaches your specified price, which means execution is not guaranteed. Your order might sit there waiting indefinitely if the price never reaches your target. Here's how a limit order works in practice. Bitcoin is trading at $45,000, but you believe it will drop soon and you want to buy at a lower price. You place a limit order to buy one Bitcoin at $43,000. Now your order sits in the order book waiting. If Bitcoin's price drops to $43,000 or below, your order will execute at $43,000 or possibly even lower if there are sellers willing to accept less. But if the price never drops to your target, your order simply won't execute. You maintain price control, but you sacrifice the guarantee of execution. Let's compare the key differences between these two order types. Market orders provide instant execution. You get filled immediately, but the exact price is uncertain, especially in volatile markets. However, in liquid markets, you're guaranteed your order will be filled. On the other hand, limit orders may involve delayed execution or no execution at all, but you have complete control over the price you pay or receive. The trade-off is that your order may never fill if the market doesn't reach your specified price. Understanding these differences helps you choose the right tool for each trading situation. So when should you use each order type? Use market orders when you need immediate execution, such as when you want to quickly enter or exit a position. They work best in high liquidity markets where there are plenty of buyers and sellers, and when speed matters more than getting a specific price. Use limit orders when you want to buy or sell at a specific price point. They're particularly useful in volatile markets where prices can swing rapidly, and you want to ensure you don't overpay or undersell. Limit orders also suit patient trading strategies where you're willing to wait for your target price. Let's recap the essential points. Market orders trade speed for price certainty. You get immediate execution, but you accept whatever the current market price is. Limit orders trade time for price control. You specify your exact price, but you may have to wait, and there's no guarantee your order will fill. The best approach is to choose based on your trading strategy and current market conditions. Both order types are essential tools in a crypto trader's toolkit. Understanding when to use each one will help you execute more effective trades and better manage your risk in the cryptocurrency markets.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.